Well, it has been a crazy week for interest rates. It's been a crazy month for interest rates. How high are they going to go? And are we going to see some reprieve anytime soon? We're going to dive in and talk about it. Today is the 24th of October, Thursday. Hope everyone is doing well. Mortgage News Daily has the 30-year fixed rate conforming loan at 6.91% today. Same survey had us at 6.68 a week ago, so we're up a quarter of a point in a week. We were at 6.18, y'all, a month ago today. We are up 3/4 of a point in the last 30 days, which is a lot. There's a lot that's moving it. If you look at the headline numbers, 3% GDP was stronger than expected. Retail sales much stronger than expected. 4.1% unemployment rate, much stronger than expected. Those are the headline numbers that would suggest that's the reason that we've seen interest rates higher. And certainly there is a lot of trading in the bond market on those headline numbers. That said, though, y'all, when you dive into the beige book that was released yesterday by the Fed, where they actually interview businesses, they're being quoted by just bellwether businesses, y'all, that sales are soft to flat and in some cases declining, from folks that are just bellwether producers in our economy. And they're having a difficult time hanging on to people and attracting new talent. So even they're soft on the job side. When you look at the jobs numbers and dive in, even though we saw a much stronger than expected headline number at the last jobless report, or the last BLS jobs number rather, 2 weeks ago Friday, that gave us that really low 4.1% unemployment rate, you dive into the details of that report, jobless claims are up 80,000, y'all. That is the highest since November of 2021. So we're sitting at 3.5-year highs as far as jobless claims are concerned. And it really begs the question, how do you get to a 4.1% unemployment rate with jobless claims at 3-year highs? So there's a lot of questions for the Bureau of Labor Statistics on how they are getting this number, whether it's influenced politically or not. Y'all know my opinions on that. And if you don't know them, feel free to call me and we can talk about it offline. But are those things, given the conflict with what the Fed is showing as far as softness is concerned, sufficient to put this much worry into the bond market? And y'all, this kind of warrants a conversation around what kind of people are bond traders, what kind of folks invest in fixed income securities. And it would be fair to say that they're the most pessimistic among us. These are the folks that crave safety and risk avoidance over all else. So they tend to gravitate to the worst possible outcome. And y'all, I would suggest that what's happening with interest rates right now is more a result of recent polling that shows that we are tilting very significantly right in the upcoming election, and that puts on the table the tax policies that show to the person that's just looking at the 80,000-foot level that revenues may be declining at the federal level if we get a Republican House, a Republican Senate, and a Republican in the White House, that the tax policies that have been proposed in this campaign are going to become law, and that could harm us from a deficit spending standpoint. And y'all, if Congress doesn't get its arms around what they spend, we can't continue to sustain $2 trillion annual deficits. That 2020 budget that had us seeing a $2 trillion deficit should have been a one-time, one-off COVID emergency craziness, not a reset to a new baseline that it has become. This just proves the point that you can't give Congress a $2 trillion license, even for something like COVID, and expect them to ever pull back in the future. They're not going to spend one penny less in the coming years, right? And that is a huge concern for the future. Now, talking about tax cuts in general, I actually went back and looked. Tax revenues, even after the initial Trump tax cuts, that is still current law, y'all. Those tax cuts do not sunset until next year. We have taken in more money, significantly more money in tax revenue than the higher tax brackets of the previous administration prior to those tax cuts going into place. So do I think the bond market is overreacting to these claims that the deficit's going to get blown up? Should we go with a Republican Congress? I absolutely think they're overreacting to that, but they're reacting nonetheless, and it's giving us what we've got. So that's a bit of explanation on why we've seen such a big movement, y'all. It's kind of following where the polls have followed over the last few weeks as far as where this election is headed and what that might mean fiscally. In any event, if you would like to discuss that further or mortgages, feel free to call me. You've got all my contact information on the screen. I think everyone on this call knows where I'm minded politically. I try to stay as far from political topics as I can, unless those political topics directly impact what we're doing. I think we're seeing some of that here. And I also think it is wrong-headed on the part of folks that are trading based on that. Because again, I think that we will see far more growth. I think we will see far more revenue if we have a really, really nice reduction in taxes. That's my view. Yours may differ. In any event, I'm happy to visit anytime. You got my number. Stay blessed, stay safe. We will talk to you next week.